So let's look at the next piece, observation. Observation is the least quantitative of the three pieces that I'm going to talk about. Observation is basically looking around us and trying to decipher where we might be in the cycle based on the things we see in our everyday lives, based on things like we've all heard the term irrational exuberance that was coined the Fed chairman back in 2008, Alan Greenspan, which is basically people going absolutely nuts over some asset class or some set of asset classes or some type of investing class. And basically you see a run-up. We saw it in the tech sector in 2001. We saw it in real estate in 2000, 2005, 6, 7. We saw it in cryptocurrency back in 2015, 2016. So you start to see this irrational exuberance. You start to see people reacting differently and acting differently and talking about things differently. You start to see people get really excited about things that they may not have gotten excited about before. We all see this influx of new real estate investors into the market the last couple of years. These people that 5, 10 years ago wouldn't even have thought about real estate, but now real estate is kind of back in the consumer conscience. That's the observational piece. Just looking around and saying, based on the things that I see, what does that tell me about where we might be in the cycle? And if you look today, I think it's clear to everybody that we are somewhere in the exuberance piece of the cycle, the expansion piece of the cycle. Looking around, it's pretty clear that we're not in the midst of the 2008 major recession. One of the big pieces of observational data that we can look at, one of the few quantitative measures that we have for observational data is what's called consumer sentiment or consumer confidence. And the University of Michigan does a poll every month. They do a poll and they plot where they say consumer confidence is, where the average American thinks the economy is, how confident they are and where the economy is. Consumer confidence starts to drop a few months or a year or two before we enter into a recession. So what we see is that consumer sentiment, consumer confidence has been pretty steady. It rose up through 2015 and it's been pretty steady since 2015. Some ups, some downs, but no major uptick, no major downtick in the last 4 years. I'll let you interpret that as you will. That probably gives you an idea of, from the average consumer standpoint, where we are in this economic cycle. Are we at the beginning? Are we at the end? Are we in a downturn? And we'll talk about what I think this chart means in a little bit. That's the observational piece. Just looking around and saying, based on the things that I see, what does that tell me about where we might be in the cycle? And if you look today, I think it's clear to everybody that we are somewhere in the exuberance piece of the cycle, the expansion piece of the cycle. Looking around, it's pretty clear that we're not in the midst of the 2008 major recession. One of the big pieces of observational data that we can look at, one of the few quantitative measures that we have for observational data is what's called consumer sentiment or consumer confidence. And the University of Michigan does a poll every month. They do a poll and they plot where they say consumer confidence is, where the average American thinks the economy is, how confident they are and where the economy is. Consumer confidence starts to drop a few months or a year or two before we enter into a recession. So what we see is that consumer sentiment, consumer confidence has been pretty steady. It rose up through 2015 and it's been pretty steady since 2015. Some ups, some downs, but no major uptick, no major downtick in the last 4 years. I'll let you interpret that as you will. That probably gives you an idea of, from the average consumer standpoint, where we are in this economic cycle. Are we at the beginning? Are we at the end? Are we in a downturn? And we'll talk about what I think this chart means in a little bit. Business investment tends to be one of the best leading indicators. The amount of money that businesses are spending, the amount of money that businesses are investing in people, in equipment, in land, in factories, is a great indicator of where the market is headed, where the economy is heading. When businesses stop investing, it's a good indication that the economy is probably going to turn. Now, you might think, well, of course it is, because when businesses stop spending, it actually impacts the economy. That's true. But business spending is also a reflection of what those people at the top of the business tend to forecast for the economy. So when CEOs and CFOs tend to believe that the economy is going to turn or slow down, they spend less. That spending less then turns into them thinking that the economy is going to get worse, and actually turns into the economy getting worse, and it snowballs. So certainly business investment not only is a good forecast of where the market may be moving, but it actually impacts where the market's going to move. So we'll talk about that. Unemployment rate. Everybody's pretty much familiar with that, especially over the last few years. We'll talk about what that indicates. Housing starts, basically the number of permits that developers are pulling to start new construction, residential new construction or multifamily new construction units. And then the stock market tends to be a lagging indicator, but we'll talk about that as well. And then we've already talked about consumer sentiment. So we're going to jump into the yield curve next.
Jay, I've heard the word yield curve inversion, right?
Yes.
So that inversion is the same thing, right?
It's a really important piece of economic data because it's been really good over the last 60, 70 years at predicting when the next recession may occur. My favorite 9 economic indicators of where we might be in the market cycle. I'm going to talk about the yield curve and then we'll come back and we'll go through the rest pretty quickly. But I do want to talk about the yield curve because, again, the yield curve tends to be a great predictor historically of where we might be in the market cycle and when the next recession may occur. So let's talk about the yield curve. 2 things you need to know to have this discussion about the yield curve. First, government bonds pay interest. What does that mean? The government raises money. The government can't get enough money from taxes. We run a deficit every year. So we have to raise money from other places. And the best place the government raises money is by selling these things called bonds. Bonds are basically debt instruments that pay interest. When we talk about bonds, we often refer to that interest as yield, but basically interest and yield are the same thing. So government sells these bonds. It's debt. It pays interest on a monthly or quarterly basis. The longer the maturity, the higher the interest. What does that mean? That means the longer you're willing to hold this government debt, the higher the interest or the higher the yield on that debt. Let's take a look at a real life example. This was back on a particular day in January 2004. I don't remember what day I picked. It was probably January 1st, 2004. But essentially, the government was selling bonds back then. Government sells bonds every day. And on that day, the government said, if you buy a 3-month bond, basically if you buy government debt that you promise to hold for 3 months, we're going to pay you a certain amount of interest or yield on that debt. If you are willing to buy a bond that you hold for 3 months, we're going to pay you about just under 1% return, annualized return, for that 3-month hold. They also said at the same time, if you're willing to hold that same debt for 2 years, we'll pay you closer to 2%, which makes sense. If you're willing to hold the debt longer, you have some opportunity cost, you have some additional risk. So the government's willing to pay you more. Plus the government's getting that use of your money for a longer period of time. So if you're willing to hold that debt, that government debt for 2 years, at that point, they were willing to pay you close to 2% in yield or interest. What if you were willing to hold it for 5 years? If you're willing to hold government debt for 5 years at that point, from January 2004, guaranteed through January 2009, the government was going to pay you about 3.5% yield. 7 years, they were going to pay you closer to 4%. If you hold that debt for 10 years, they would pay you 4.5%. And if you were willing to hold that government debt from January 2004 through January 2024, they would pay you annualized interest or yield of close to 5.5%. These data points, when you put them together, create a curve. And this is what we refer to as the yield curve. And the yield curve is a visualization of how much the government is willing to pay in yield for different durations of bonds at a given point in time. Typically speaking, what we see is that the lower duration period is a lower interest rate or yield. The higher duration period, the longer you're willing to hold the debt, the more the government is willing to pay. When I say the government is willing to pay, it's not really the government that's saying, I'm going to pay you this much. Nobody in the government sets this rate. This rate is set by supply and demand. When there's a lot of demand for a particular length bond, rates are going to go down because the government doesn't have to pay as high rates. If everybody wants those 3-month bonds, the government isn't going to have to pay as much. to provide those bonds. It's simple supply and demand. And it works the other way as well. If demand goes down, the government wants you to buy it because they want to build that demand. How do they build that demand? They offer higher rates, or the market, not the government, the market offers higher rates. So generally speaking, in a healthy economy, the curve that we're looking at, and this is what's referred to as the yield curve, this plot of data points, different duration bonds and their interest rates. In a healthy economy, we tend to see it moving from the lower left to the upper right. The shortest term bonds pay the lowest in yield. The longest duration bonds pay the highest in yield. Hopefully that makes sense. This was January of 2004. This is what the yield curve looked like. This plot of interest rates for various duration bonds look like in January 2004. When investors start to get scared, two things happen. First thing that happens is investors flee to longer term bonds. They're concerned that real estate might crash. They're concerned that the stock market might crash. They're concerned that gold might go down and the value of their assets might go down. And so they look for some safe place to put their money long term. The first thing they think is US government debt. It's one of the best investments out there in terms of likelihood to repay. So the most safest investment on the planet is US government bonds. So when investors start to get scared with their money, what they do is they take it and they put it in really long-term US government bonds for protection.